Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, last week I spoke about how markets were stalling with the equity rebound in danger of running out of steam. And in particular, I focused on the DAX in Germany and the S&P 500 in America, highlighting key levels of resistance on each index that were proving tough to break. And if you recall, a resistance line from a technical analysis point of view is a level or price that an asset or index has trouble breaking above. Now, last week I explained that the line of resistance to watch on the S&P 500 was 4,500, while the DAX was struggling with 14,500. And I also mentioned that if either threshold was breached to the upside, then the rebound was likely to have further to run. And furthermore, both levels were just above their respective indexes' 200-day moving average. Now, after a number of attempts, both indices finally broke above these lines of resistance, with the S&P 500 now currently sitting at about 4,600 after bursting higher once the 4,500 level gave way. Meanwhile, in Germany, the DAX sits just above 14,600, having been as high as almost 14,900 after its own breakout. So is that it? Is the bear market over? Now, of course, it's a brave person that makes such a bold statement, as investment markets have a way of humbling you. But what is not in doubt is that the weight of evidence from a technical standpoint suggesting that the market has turned a corner is growing, even if it's not conclusive yet. Now, the S&P 500 has broken out of a downtrend that started on the 3rd of January and has now broken above its 200-day moving average, as I mentioned, which sits around 4482. Now, the buy the dip mentality has returned to the US stock market, and the Nasdaq 100, by way of example, has enjoyed one of the best 10-day streaks in recent history. Since mid-March, the index is up 15%, which brings the year-to-date losses down to minus 8%. And the German DAX is attempting a similar breakout to that which we've seen on the S&P 500. And if it holds, then it will be positive for the index. Yet, most of the equity market moves don't really make a lot of sense from a fundamental point of view. After all, the war in Ukraine is ongoing, and despite positive headlines about possible Russian troop withdrawals and constructive peace talks, the war is, as I said, still ongoing. And not only that, but central banks in the UK, US and Europe are tightening monetary policy. In the case of the US Federal Reserve, the market has been told that the pace of these hikes will likely be aggressive, yet equity markets seem unfazed. And in the past shows, I've often highlighted that Bitcoin has been a good indicator of overall investor risk appetite, and the digital currency has rallied 25% since its mid-March low and sits at $47,300 for a Bitcoin. Now, this is also partly a reflection of the rally in tech stocks, but while equity investors are prepared to look beyond the Fed tightening phase, the bond market is still not. I mean, the 10-year US Treasury yield currently sits at 2.33%, having reached as high as 2.5% in the last week. And it means that the yield has broken out of a downtrend that started almost 30 years ago. Now, this could be significant if the trend continues. And unsurprisingly, as March draws to a close, we are looking at the worst quarter for bond markets, and in particular US Treasury, since 1973. It is worth noting that the downtrend in bond yields has been tested numerous times over the last 30 years, most recently in 2019, before bond yields then collapsed, sending the value of bond funds higher as fears of a recession were starting to increase. And when the pandemic finally hit, equity markets collapsed and the fall in bond yields accelerated. So those who didn't turn their backs on bonds were rewarded in the end. And it raises the question, will this time really be any different, or are bonds now in some form of death spiral caused by rising inflation and central bank tightening? Now, the volatility in bond markets has also picked up significantly in recent weeks, while at the same time the S&P 500's VIX, which if you remember is a fear gauge, has tumbled back below its long-term average of 20. That in itself is very unusual, as historically we often see equity market volatility pick up in response whenever this divergence occurs. Now, if that happens, it means we are likely to see equity markets react negatively. But for now, equity investors are ignoring what the bond market is telling them, instead sticking their fingers in their ears and cherry picking the bits of information that they want to hear. For example, the yield on the 2-year US Treasury rose above the yield on the 10-year US Treasury this week for the first time since 2019. This yield curve inversion is a closely watched recession indicator, but equity markets remain unfazed by the potential for a recession. Equity investors also seem to be looking beyond future Fed rate rises and focusing on the bond market's suggestion of potential interest rate cuts in 2023 or 2024 after the Fed tightens too much too quickly and makes a policy mistake. Any hint that central banks may support the market has caused equity markets to rally in response, no matter how far off in the future that may be. Now, in the coming weeks, we will find out whether the breakouts in equity markets and bond yield markets will hold. Equity markets will soon have to navigate another corporate earnings season, which will include the impact of the war in Ukraine on corporate profits. Now, this could be a headwind, and given that most equity markets are only 5, maybe 10% below their recent or all-time highs, it's unlikely that the situation in Ukraine has been fully priced in current valuations. And with so much uncertainty, it pays to go back to technicals again and be able to navigate and make sense of that noise. So, for example, on the S&P 500, 4,500 remains an important area for the market to remain above if the rebound is to continue. And for the DAX, the equivalent level is still 14,500. Now, if you want to look at bond yields, the 2.2% level on the 10-year US Treasury yield is important, because if we drop back below there, which means bonds are actually rising in value, then the multi-decade downtrend in bond yields will likely resume as it did in 2019 when recessionary fears last began to emerge. There are clearly a number of parallels to be drawn between late 2019 and now, but let's just hope that the mentioned similarities end there, because a few months after that period in 2019, then most equity markets entered a bear market in 2020, although admittedly it was a result of the pandemic. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com, Twitter, money to the masses with the number 2, and you can find us on TikTok, Instagram, Facebook, and of course, don't forget to subscribe to our YouTube channel.